And we are live. What's up, guys? Welcome back to another live episode. We got a special guest for you today. We got Kyle, who is a serial technology entrepreneur from Austin, Texas. Prior to founding Multicoin Capital, Kyle founded Pristine, which built software for Google Glass used by Surgeon. He served as CEO, and under his leadership, Pristine grew to millions of dollars in revenue. Kyle, welcome to the show, man. How you doing?
Amir, glad to be here. Thanks for the time. Looking forward to it.
Yes, we've been trying to connect for a while. On and off, on and off. You're busy, I'm busy, technical issues. But we're here. We're finally fucking here. And we're going to have a good chat, an honest chat. And the chat that I want to have with you, because you're knee deep on the investment side of the industry, is two things. Number one, when it comes to risk analysis from a hedge fund point of view, investing in, let's say, tokens or variations of tokens. And B, I really love the paper that you wrote a month or two ago talking about token velocity. So why don't we start with the first part? You as an investor working with your own fund, how do you actually calculate risk in this industry?
Yeah, happy to dive into that stuff, Amir. And just for some clarity for the audience, I run Multicoin Capital. We're a crypto hedge fund. So we invest exclusively in tokens. So when we think about risk in the space, I find a lot of the traditional financial metrics to not be too useful. Things like Sharpe ratios and volatility ratios and those kinds of things. The reality is the market is overwhelmingly noisy. I think one of the key things to think about is to have a strategy and stick to it. So, for example, we are not traders. We spend most of our time, rather than watching charts and figuring out kind of what's going on in the market on a short-term time scale, we spend most of our time learning and trying to zoom out a little bit from the trees and really see the forest kind of at a higher level and make investment decisions accordingly. So as long as you have your strategy and stick to it, I think that's really key. Another thing we really think about when we think about risk is liquidity. So, obviously people like talking about pre-ICOs. If you can get into them as a fund, there's a lot of exciting opportunities there. The problem with pre-ICO investing, of course, is that it's illiquid. And as a hedge fund, that's a real risk. If you have too much of your portfolio, in illiquid assets, and then let's say the market crashes, and then maybe your investors start pulling out of the fund, you can quickly end up in a situation where you have these illiquid assets that you can't liquidate, and your investors are trying to pull out of the fund, and so you have a real risk of kind of basically your hedge fund exploding when that happens. So we think about liquidity very seriously. Today, given the state of the markets and kind of the frenzy we're in, we're really working hard to minimize our illiquidity. We're right now we're at about 5% illiquid, and we're probably going to stay around that neighborhood, just because you never know what's going to happen in this market, and we don't want to be left in this kind of awkward situation. So that's another major area. And then the last kind of, I'd say, major bucket of risk we think through today is let's call it the things that cause the bubble to pop. So there's a few obvious catalysts, things like what if an exchange exploded, right? If Coinbase exploded, that would obviously be really bad. If Bitfinex exploded, if Zappo somehow got hacked, if any of those institutions got exploded, it could cause the bubble to pop and a long downwind from there. Another major risk obviously is government crackdown. Thus far, we seem to have it seems like most of the major governments around the world have said, hey, this crypto thing is interesting. Don't be scams and frauds, and you can kind of pay your taxes and you can kind of keep doing this stuff. That seems to be the general sentiment of governments. That could change in a heartbeat. I mean, there could be a terrorist attack linked to Bitcoin tomorrow, and if that happens, I can guarantee you that the markets are gonna take it down. So, we think well, if that happens, how do we want to be positioned? If Coinbase explodes, these are things that we can't possibly forecast, but that there's a real non-zero risk of them happening. And so those are the kinds of things we think about when we think about risk in this kind of a frenzied market cycle, and we just don't want to be stuck, holding the bag.
But what kind of theses do you have of Multicoin Capital when it comes to actually investing? You see a white paper, a pitch deck in front of you. Do you have kind of a checklist that you go, does it have this A, B, C, D, E, F?
Yeah. So we have a general process we follow. It's not too rigid. There's just all kinds of idiosyncratic things to think about, but we have a general process. So the first is okay, well, what's the problem? Understand the problem they claim to solve. And then really trying to understand, is the solution something that needs to be a blockchain? We don't invest in anything that doesn't need to be a blockchain. So one of my kind of examples of a space right now is the idea of decentralized work marketplaces. So these are competitors to Upwork or to Fiverr and those kinds of things. And there's like Gems and Storm thing, and there's a bunch of these decentralized like labor market things that connect people who need to do different jobs together. I don't find that to be something that's like you don't need a blockchain for it. There's arguably some benefits of decentralization, but you like we have proof today that you don't need a blockchain to solve that problem. I'm personally a huge fan of Upwork. I've used Upwork for years.
I love Upwork. What people don't understand about these platforms, what they offer is amazing customer service.
Yeah. I mean, amazing. And like the liquidity's there, the supply of laborers is there, and like they generally do a good job. And like for the cost I'm paying, like I'm thrilled. So I find, like stuff like that, for example, I don't think is necessarily something that's blockchain native. There could be some other interesting things to decentralize in the future. But as of today, like I don't find that to be a very compelling use case. So to zoom back to your question of like, what do we look for? So one is what's the problem? Is this something that fundamentally needs to be decentralized and solved by a blockchain? Once kind of those two boxes are checked, the next thing we really look for is like, what's the size of the market? Let's say the thing works as advertised and becomes a massive success. Well, how big can it get? And like some things are $50 million problems globally. Some things are $50 trillion problems globally. And like, it just depends on the nature of the market they're going after. So like for us, like investing in smaller markets just doesn't necessarily make sense. It's just not a good use of time or capital. For us, I mean, right now we have 30 million in assets, and I mean, we're going to cross 50 in the next month or so. Like, we can't aim at small markets. It's just not viable for our current asset base. So like that's a big thing we look at. The next is probably the token mechanics. So like the velocity thing that you mentioned earlier, and I think we're going to talk about in a few minutes. That's a huge thing to us, is understanding, okay, well, what are the motivations for people to hold the token? What's the token used for? As the system grows and matures, how can we expect that to play out? That's a very, very important thing we look at. Next is the team. So who's building it? What's their backgrounds? How scrappy are they? What are they doing, et cetera? And then the actual technology itself. So looking specifically at technical risk. We don't necessarily, it's not a good use of our time to go review code. I am an engineer by background, but like that's a terrible use of my time. A much better use of my time is to understand, okay, are there fundamental technical risks here? And if so, then like instead of trying to really like if there are fundamental technical risks, the way we manage that at the portfolio level is we simply size the position down based on the risk profile, right? The more ambitious the claims are, the more you want to size down, because like what if the thing just doesn't work for whatever reason, right? So those are kind of the major buckets of things we look for before we make an investment.
And so talking about like token utility, you probably see a million deals on your table every single day. What's your take on token utility? Do you have a specific definition, a Multicoin, of what your definition of token utility is?
I don't think we've ever tried to define like what is utility in the concept of a token. I mean, you can say like we're seeing security tokens, we're seeing money tokens, we're seeing governance tokens, right? We're seeing kind of different classes of tokens. Some of these things are overlapped. Some tokens have different features of them. In general, like when we think about tokens, we think of three major buckets. We think of security tokens. So that's like taking an Apple stock certificate and putting it on a blockchain, which is not terribly interesting for us. We don't invest in security tokens. The next category are utility tokens. We do invest in utility tokens. And then the third category, I call them our money tokens. So these are things like Bitcoin, Monero, Ethereum.
Can you give an example of a utility token? Some people probably won't know exactly what it is.
Yeah, so most of the ICOs these days are utility tokens. So Civic, Basic Attention Token, Funfair, Augur, these are all Filecoin. These are all utility tokens where that token is designed to be used in some specific network to do some specific thing.
Okay.
And then the third bucket there was money tokens. So Bitcoin, Bitcoin Cash, Monero, Zcash, Ethereum. I think all of these are making a play at being money or being some sort of general purpose currency. And so we think there's also like that's a third bucket of tokens.
And what's your take at Multicoin with token distribution, token models? Like, for example, I know a lot of funds in the space, a lot of whale groups as well. And obviously everyone's looking for 30, 40, 50% off pre-ICO. Do you guys have initial framework of what you think is a good token model of distribution?
So it depends on the usage of and how the token's supposed to be used. So for example, there are a number of tokens out there today that are not intended to be used as money. If your token is not intended to be used as money, then the initial distribution basically doesn't matter as long as you fundraise.
Mm-hmm.
If you have a security token, then that's great. If you have what I call a tax medallion token, so for example, Augur is a tax medallion token. In the Augur network, they don't really care about distribution of tokens beyond some, let's call it minimum threshold. And the reason is like the Augur people in the Augur will go do work for the network, but they don't need, if you want to make bets on the Augur platform, you don't need to buy rep tokens. So Augur doesn't care about distribution as much. So we always try to understand, distribution in the context of, what are the stated goals of the token and how the token is intended to be used. From there, I don't have a strong preference one way or the other about things. We'll evaluate them pretty idiosyncratically. We do look for obviously teams that have some sort of unique go-to-market, such that not just for the ICO, but even after the ICO, how are new users going to find and discover the platform and get engaged and get involved? And that's kind of the go-to-market challenge, and that's a major thing we do look at is, okay, well, you're building this thing, right? Like, how are people going to use it? I kind of, Bitcoin is kind of the ultimate, like there was never ever like a cohesive top-down strategy. You had guys like Roger Ver in the early days, pick up Bitcoin and start evangelizing it, right? And so there was that. If you look at Ethereum, people say, well, Vitalik just built Ethereum, and Vitalik and Gavin and those guys, and like that's not true. But Vitalik has lived in an airplane for the last 3 years. Like that guy has been traveling.
I know.
Right, and like he's evangelizing, he's speaking, he's getting people engaged. Like they've had community management teams since inception. Like they have been doing a lot of hard work to get the Ethereum community going. And like, I mean, it's amazing, right? Vitalik is worth a few $100 million by now. And like the guy basically doesn't have a home because he's just on the road constantly. So like getting your thing out there takes a lot of real work, and you need a real plan. Everyone's plan shouldn't be go live in an airplane and like travel and evangelize. That doesn't make sense for everybody. For smart contract platforms, that is probably necessary. But if you're building something more specific, whether it's a platform for gambling or a platform for identity management or whatever, like you need to be thinking about go to market very differently.
But this is a perfect segue tying into token velocity. Like my take on majority of these tokens, like 99% of you people don't want to keep them in the future. There's no use case for them whatsoever.
Yeah. So for some context, maybe let me describe the token velocity problem if you haven't, if you're not familiar with it. If you do want to see this in writing, if you go to our website, multicoin.capital, we have a featured sections.
I'll leave a link below the video so people can click on it.
Awesome. Yeah. So please go check out that post. It'll kind of walk you through the problem. I'll give a quick verbal description now. So the token velocity problem is basically the problem that for a lot of use cases, for utility tokens specifically, that there's not a strong incentive to hold the token. So I'll use ticketing as an example. Ticketing is actually a use case where blockchains make a ton of sense in the ticketing business, like going to a concert. There's a lot of fraud. That's people literally like just copying a ticket and selling the same ticket multiple times. There's like the problem of scalpers who just buy the tickets on, when they go on sale and sell them at a 50% markup. Like if you make these things on a blockchain, you guarantee there's no double spend problem. You can like set rules for profit shares, ticket resales, those kinds of things. There's a lot of pretty obvious benefits to putting ticketing on a blockchain. The problem that I see with the ticketing kind of class of tokens specifically is that like if I want to go buy tickets to a Eminem concert, right? Let's say Eminem's the venue he's at takes these proprietary tokens for the system. So I have my Ether. I go trade my Ether for these proprietary tokens. Then I go like immediately 5 seconds later trade those proprietary tokens for the Eminem concert tickets. Right, then the venue received those proprietary payment tokens, and they go and 5 seconds later turn around and sell those for Ether. And so if you think about that, like that set of tokens just turned over in 10 seconds. And so the problem is like if that happens, then there's no reason the price of that token would ever appreciate. No one's ever holding the token. So what's crazy about this is that if you kind of follow this logic out a little bit, you could actually have systems, or you could have a system that like you're powering billions or tens of billions of dollars of global commerce, but the value of the monetary base supporting that could be 10 or 20 or 30 million dollars, and the velocity is just 100 or 1,000x, and so the turnover is so fast that the token can't really capture any value. The specific equation that you use to model this is MV equals PQ, where M is the value of the monetary base and V is the velocity, and then PQ basically is the GDP, or like the total money that flows through that system. And so it's a real problem, and basically all utility tokens kind have the problem. The generic solution is you need to have reasons. You need to have a reason to hold a token, and there are like different kinds of solutions to it. So there's like, you can come up with what I call kind of velocity sinks, or like reasons that like someone needs to like hold the token. So in the case of the concert tickets, for example, you could say that for a venue to list a show, they need to stake X number of tokens from the day they start selling tickets until the day the concert lasts. And so that would lock up some tokens and take them off the market. You could say, like, if it's a show that's going to be sold out, you could ask consumers and say, hey, you need to buy these tokens and stake them like early, and then we're going to do priority access based on like how long the tokens have been staked. So like there's these kinds of mechanisms you can build into different systems to create what we call velocity sinks. Those will obviously help. It's not clear to me how much they will help, and that certainly is very it's very idiosyncratic. But like there are conceptually ways to reduce velocity. I'm working on a number of ideas on some more generic frameworks that any token can adopt. And like you'll start to hear us at Multicoin Capital talk about those in the coming months.
And what's your, for me, one of my issues with a lot of these app tokens, utility tokens, like, we're using YouTube and Facebook and Twitter. They don't force us to use a token. I don't need to use a token to be on their platform. The whole idea of like, and it's also like onboarding issue, right? Oh, I got to have this thing, this technology, this wallet, yada, yada, yada. The whole idea of me needing and mandatorily using a token on the platform, I don't see that as like a long-term solution for platform success.
Yeah, so I concur, right? Like if you tell people the first thing you need to do when you get on my site is to go like buy my token to interact with my site, like that's not a good user experience. That problem will be abstracted away through so 0x, Will from 0x has spoken publicly about this.
Yep.
He calls the idea token abstraction. And you can imagine like MetaMask or some equivalent system in the not too distant future integrating with some 0x relayers, a decentralized exchange, and then using that to where like you have Ether in your wallet, and then you go to some website, say you go to a casino, it's gambling, and that's powered by fun tokens. Right? Like it seems pretty obvious to me that in the not too distant future, the site will communicate with MetaMask and say, hey, I need fun tokens. MetaMask will communicate with the site and say, I don't have any fun tokens. MetaMask will then automatically, whenever there's some price listed on the web page, it's going to communicate with MetaMask and say, here's how much fun tokens you need to buy. Here's the conversion price, based on current Ether, and then just show the number of Ether you need to spend to like do the thing you want to do. And all of that can happen transparently and in real time, so the user doesn't even know. That's a good thing for the ecosystem. I fully expect that to happen. As a result of that happening, that will increase velocity, because that means consumers will literally trade their Ether for some other token and then immediately spend that token without ever having held it for more than a couple of seconds. Right? What the vendor does with that token when he or she receives it is less clear. But conceptually, if their interest is holding Ether as a general purpose currency, then like that's exactly the velocity problem we talk about. The UX around it will get better over time.
Also, there has to be staking solutions. You have the Sybil attack issues over here, where if I can enter an ecosystem and spam them directly without actually having any skin in the game, that's a massive problem from a lot of these ICOs that I've seen. Yeah,
absolutely. I mean, you need to use something like Civic, for example, to handle KYC, depending on the nature of what you're doing. So Orchid has this problem, right? The Orchid protocol is a system for, it's like a decentralized VPN, or it's more like Tor with a token. And like the Orchid team, right? They don't want to do staking to get people to be a relayer, because they want there to be 50 million relayers in the world, right? Like the point is to not have 5 relayers, but to have 50 million relayers. And so you have a real challenge on how you deal with Sybil attacks in this scenario. Again, every system needs to be managed a little.
Have you looked into Plasma?
I have. I think, yeah, I've spent some time on Plasma.
What's your take on that? Because you can actually stake ERC20 tokens within those contracts.
Yeah, so in general, I'm a big supporter of Plasma. I think it conceptually makes a lot of sense to me. The good thing about Plasma is like structurally, we know it can be done. The risks around, like we know that if it works, the scalability like clearly goes through the roof. The risk with Plasma is like, how do you handle collapsing the thing and like going back up the chain if you have bad block producers in a given subchain? That is very unclear to me how that will work. I don't think there's a lot of clarity out there, but like it's a very exciting concept. In terms of staking tokens in those, I guess I'm not familiar, Amir, with specifically what you're referring to.
So like, let's say you and I do an ICO, we have a utility token, and going back to what we're just talking about, Sybil attacks and skin in the game and token velocity, with Plasma, we can have the option of on our system for you to use it. You can actually stake your token on Plasma. So I don't need to just stake Ether. I can actually choose which token I want to stake as opposed to just staking Ether.
Right. I mean, you can have any ERC20 token in any Plasma chain. Yeah.
Yes. Yeah. So that's fascinating for me, where you actually have optionality. So I'm big on optionality, where like, let's say you go up, and you mentioned earlier with the relayers and 0x, what they're doing, where you have an ecosystem, this, whether it's a DApp or utility token or app token, where you have the optionality of choosing what you want to use.
Yeah, there's a lot of value in option. Like that's the whole point of a decentralized ecosystem, is that consumers have a choice and builders can build, right? So I'm all for it.
So what would you like to see going forward? And I know you mentioned that Multicoin Capital is going to be releasing a framework, but where would you like to go, or what would you like to see the ICO space change? Like, you know, there's obviously problems through evolutionary process right now, but what would you like to see in the next 6 months happen?
In the next 6 months, I would like to see, so this is a little bit simple, but I'd like to see a movement back towards pitch decks and away from white papers.
Yay.
I like pitch decks. I think are much easier to read and process than white papers. For something technical, I prefer a white paper, but for like a general, hey, here's the problem, here's the solution, here's what we're doing, I strongly prefer a pitch deck. So that's somewhat semantic. I would hope all ICOs, use ENS. ENS now is usable, in Mist, is usable in MetaMask to make payments. Please use ENS to help avoid with hack risk. I think teams should be raising less money and selling fewer tokens, and have more in the reserve, and intend to raise more money later at a higher price, much like traditional startups and venture capital work. I think that's
similar how Vitalik and the guys from TrueBit interactive coin offering paper.
No, so I'm not referring to the interactive coin offering paper. I'm referring to, like, let's say when you launch your system, you do your first ICO, you sell 15% of your tokens, and then
I got you. Kind of like pre-seed, Series A, Series B. Yeah, okay.
Exactly. Yeah. So multiple kind of rounds of funding at higher and higher prices. I like that model a lot. I think the idea of trying to raise $50 million, after 4 months of work is crazy. Yeah. So those are some of the things I like to see happen.
Fantastic. All right. Well, we're going to wrap it up there. Kyle, thank you so much for coming on the show. If people want to get in touch with you, maybe they have a pitch deck for you as opposed to a white paper, what's the best resource for them to contact you?
Yeah, so you can find me on Twitter. I'm pretty active on Twitter. My Twitter handle is just Kyle Samani, which is just my name. You can go to our website, Multicoin Capital. You should subscribe to our blog. We publish, I think, some of the best research in the crypto space. And then feel free to email me. You can just email me. My email is kyle@multicoin.capital.
Thank you, Kyle. And once again, I wish you best of luck, brother. Talk to you soon.
Awesome. Thanks, Ameer. Appreciate it.
Cheers. Bye.